Very good morning on this Tuesday, July 1st, and we kick off the third quarter of the year. The last 24 hours continued the bullish momentum in U.S. equity markets, with major indices hitting new record highs and Wall Street closing out a second straight winning month. This rally is fueled by easing trade tensions, dovish signals from the Federal Reserve, and strong corporate news. However, there are signs of caution beneath the surface. The volatility index, VIX, rose even as stocks climbed, indicating that investors are hedging or growing more cautious. All major U.S. indices advanced, capping a strong month and year-to-date performance. Technology, especially artificial intelligence, AI-related companies, led the gains. Banks performed well, supported by the Fed's positive assessment of their resilience. Communication services, consumer discretionary, and industrials also posted gains, while energy lagged. Several corporate events drove notable stock moves. A major tech company surged after its acquisition of another was approved. A solar company jumped on new Senate taxes favoring domestic manufacturers, while others in the sector fell as tax credits for solar installations are set to phase out. A tech firm rebounded on news of an AI partnership. A pharmaceutical company rose on positive vaccine trial results, and another tech company gained after buying more Bitcoin. The AI trade remains a dominant market driver, and policy changes, like the Senate's budget bill, are creating clear winners and losers within sectors. The market's strong performance is increasingly concentrated in specific themes and companies, making selective stock picking more important than broad index investing. Despite the rally, the VIX rose, which is unusual and suggests the market could be vulnerable to a pullback or increased volatility. Technical indicators like the S&P 500's Relative Strength Index are in overbought territory, and more stocks are trading above their long-term averages. Investors should be prepared for profit-taking and choppiness, especially if economic data disappoints. Treasury yields eased, reflecting expectations for Fed rate cuts, even as inflation data ticked higher. The yield curve remains a concern. It was inverted for a long period, which historically signals recession risk. While the curve isn't deeply inverted now, its history suggests economic fragility and the possibility of a recession later this year or in 2026. Investors should remain cautious and consider defensive strategies. Municipal bonds underperformed in the first half of 2025 due to tax policy and high issuance, but a strategist expects issuance to moderate and returns to recover in the second half. This highlights how policy and supply can create opportunities in niche markets. The U.S. dollar weakened against most major currencies after the Fed chair's recent testimony, which gave no new hints about rate cuts. The Canadian dollar strengthened, and the U.S. dollar-Japanese yen pair stayed range-bound. Currency markets are highly sensitive to central bank signals and trade policy developments. Money market funds saw continued inflows, reaching record assets, as investors sought safety and yield amid uncertainty. Both retail and institutional investors increased their holdings, especially in government funds. Recent U.S. Treasury auctions saw strong demand across maturities, with significant participation from foreign buyers, underscoring the global appeal of U.S. debt. The options market showed heavy put activity on major indices and stocks, indicating hedging against downside risk, while one energy company saw unusually large call buying, suggesting speculation on a positive catalyst. The Fed's lending facility saw record overnight borrowing, signaling tighter funding conditions. The Fed has kept rates steady, but markets expect cuts later this year. Money supply growth has slowed, but liquidity remains ample due to strong demand for money market funds. European Central Bank. The ECB has started cutting rates and reaffirmed its inflation target, but growth is weakening and more cuts may come if needed. Bank of England. The BOE held rates steady, balancing falling inflation with ongoing risks from energy prices and global uncertainty. Bank of Japan. The BOJ is beginning to normalize policy, reducing bond purchases and keeping rates low, as Japan's economy recovers moderately but faces global trade headwinds. Bank of Canada. The BOC held rates steady amid mixed economic signals and uncertainty over U.S. tariffs. Reserve Bank of Australia, the RBA, and its regulators are monitoring risks from global trade and market volatility, but the financial system remains resilient. Swiss National Bank, the SNB, cut rates to zero to counter low inflation and currency appreciation, but expects growth to slow and unemployment to rise. The first half of 2025 saw a surge in IPOs and listings, especially in technology and healthcare, reflecting strong market confidence. However, tariffs on Chinese goods are starting to push up prices for U.S. consumers, and major retailers are warning of further increases. Trade policy remains a key driver. Optimism is growing over a U.S.-China deal, but U.S.-Canada relations are tense after Canada dropped its digital tax to resume talks. Domestically, the Senate's budget bill is reshaping the solar sector, favoring domestic manufacturers over importers. Regulators are extending deadlines for new reporting rules to enhance market transparency, and the New York Fed is launching research on the economic impact of natural disasters, reflecting a broader focus on climate and societal risks. Looking ahead, U.S. equities are likely to remain volatile but biased upward, especially in AI and growth sectors. However, technical signals and rising volatility suggest a pullback is possible, especially around key economic data releases. Bond yields may stay range-bound, with direction depending on jobs data and Fed signals. The yield curve's recession warning means investors should keep some defensive positions. Currency markets will react to central bank moves and trade news, with the U.S. dollar likely to stay under pressure if rate cut expectations persist. AI and technology stocks remain attractive, but require careful risk management. Domestic solar manufacturers could benefit from new tariffs. Biopharma companies with positive trial results offer growth potential. Municipal bonds may rebound as issuance slows. Short to medium-term treasuries offer safety if recession risks rise. Tactical currency trades, long Australian dollar versus U.S. dollar, or short U.S. dollar versus yen if policy divergence widens. Gold remains a hedge against inflation and uncertainty. Volatility products or put options can hedge against sudden market drops. The market is being driven by strong narratives in technology and policy, but underlying risks, like rising volatility, yield curve signals, and global uncertainties, mean risk management is crucial. Investors should stay nimble, monitor economic and policy developments closely, and be ready to adjust strategies as conditions evolve.